Hello, everyone. It's your host, Darrell Thomas of VRIC Media, your most trusted voice in metals and mining. I want to let you know about the New Orleans Investment Conference. The link is pinned in the comments below, as well as the description. I encourage you to click that link to check out the New Orleans Investment Conference, as I will be there in person. We'd love to connect with you all. And this is coming up very soon, from November 2nd to November 5th. If you are unable to make it in person, there is a virtual option. You're going to have some of the most well-known speakers that I'm sure that you listen to and people that we bring on this show. Just click that link in the description below to check it out. Thank you all. Let's get to the interview. Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we had the pleasure of meeting with Don Durrett of goldstockdata.com. How you doing today, Don?
Pretty good, Darrell. First time on your show. Looking forward to it.
Yes. Looking forward to engaging on these important topics. And so first I want to start with the recent performance of gold and silver, as we had a huge run up. I was actually telling some friends of mine recently that, typically gold doesn't run up that fast. We had a big move in the last 3 months, and then now we're experiencing a pullback and a cool off period, which I was expecting. But some people may be running for the hills thinking that this an opportunity is over with. And so I want to get your perspective there on the recent drawdown and what's your outlook moving forward.
Well, gold's corrected 9.6%, so almost 10% intraday from the top to the bottom, 43.79 down to 39.58. I expected it. I mean, so I've been doing this since 2004, kind of every day. I started buying juniors in 2004, and 10% corrections were the norm. I mean, if you go and look from 2004 to 2011, which is a bull market period, gold rose 600% in that period. Gold corrected average every year 10%. So a 10% correction in the bull market is the norm. This is not unusual. And I've been telling people that got in late to this to expect your portfolio to go down at some point 20 to 30%. So the GDXJ is down 21%. So most people, if they have a gold silver portfolio, they're probably similar to GDXJ, probably maybe a little more aggressive or a little more conservative. So some people are down 25%, some people are down 18%. But this is normal. This is a normal in a bull market. As a matter of fact, we were just GDXJ and the HUI, all they were doing was going straight up since August, just boom, boom, boom. And all we were seeing was green, green, green. When that happens, you're just chasing stocks. You don't want to do that. You don't want to chase stocks. You want to buy dips. That's when you make your money when you buy, not when you sell. And so you don't want to be chasing these things. So a lot of people, they're kind of late to the party and they're chasing, and those are the ones that are kind of down. But GDX is up over 100%, 110% year to date. And so if you came in, if you've been in this for a while, you're still up really big. And GDXJ is up 200% over the last 3 years. So the longer you've been in this, the more you're up. So 10% correction, it wasn't very painful. I mean, it wasn't that long ago for us that have been in this trade when the HUI couldn't even get above 300. From 2013 to 2020. I mean, we were down there. We were retesting 200, every year or two. 200, and now we're over 600. So, see, the HUI is at 557. So it was at 657. It's down 100 points, 15% from its top. But 557, it was at 200. So if you've been in this in a while, it's kind of a nothing burger. We've seen this over and over again, and we're up. And the key here is that the bear market's over. We endured this bear market. It's not completely over. And what I mean by that is we're in this. If you're in a gold silver trade, you're in this for the big alpha. You're in this for the prize. And so we've been waiting very, very patiently for the bull market, for the breakout. We want the wind at our back. Now, that happened in gold in March of 24. But it didn't happen in silver until August, just recently, August of 25. Silver didn't join the party. Gold and the miners, they basically took off. Not so much the miners, but gold took off in March of 24. And in first week of April, I basically said, that's it. We don't have to worry anymore about gold going back down. That bear market ended. So the bear market in gold, it literally ended in March of 24. And we're way above the 200-day moving average, and we won't go below that for another 3 years. So we entered a bull market in gold March 24. Now, when I say the bull market, I mean kind of a powerful bull market. Now, we entered the bull market in December of 19, but it was very light. It was light. Now we're in the power. We got into the power mode. Once you get into the power mode, it's like you don't have a lot of fear. Now, silver in August it went above 40. And it did the same thing that kind of gold did in March, and it kind of went into power mode, and that's when everybody kind of jumped in. And then the HUI, that was kind of the next key to kind of jump in on the party, and that happened in tandem with silver in August. So you saw the HUI go from 400 to 600 fairly quickly. And so now there's one final thing that we need. And so we're in this correction, but we're not really in where kind of off to the races, everybody's the mania phase. We're still early innings. So what's necessary? What's the last thing to happen is that we need the S&P 500 to stop going up. The gold and silver miners do not do well when the economy is strong and the stock market is strong, because it's a speculation bet. Gold is a hedge. Historically, the only time gold does well is when the economy does poorly. The 1930s, the 1970s, and the 2000s. That's when the miners, gold went up, like I said, both of those periods, if you look at, now gold was controlled in the 30s, but homestake mining did extremely well. But in the 1970s, gold went from $35 to $850. Because this was economic problems, that's the only time they liked gold. And then from 1982 to 2000, gold did absolutely nothing, right? Because the economy was strong. Mm-hmm. And nobody cared about gold. In the 2000s, it basically stayed at 250 the whole decade. You didn't have any blips up to $1,000 in the 2000s. It didn't happen. It just 250 just flatlined. Nobody cared. So historically, nobody cares about gold when the economy is strong. So you have to ask yourself, what in the hell's going on? Why is gold? You recently hit an all-time high. Why did gold go from 2,000 to 4,000 when the so-called economy is strong and S&P is at an all-time high? And this is where you have to read between the lines. You have to recognize that Wall Street's literally lost their mind. A perfect example is right now the stock market is at an all-time high, and corporations are announcing layoffs. And this is one little tip of the iceberg. I mean, you start looking at all these data points, and you realize what in the hell's going on. There's a massive disconnect between what the stock market is doing and what the economy is doing. It's a total disconnect. It makes absolutely no sense, but really what it is, it's greed in tandem with basically narratives that are misleading. So they want to tell you that GDP is strong, that the consumer is strong, and that earnings are strong. All three of those are lies. They're not true. And we're going to find out really, really soon. So the Max 7 basically have a powerful economic advantage over their counterparts, if you will. They're kind of like monopolistics. Microsoft, for instance, Amazon, Facebook. These are companies that have kind of not necessarily monopolistic, but very strong advantages over there. They have basically competitive advantages where they can generate profits, and so they can generate profits irregardless of the economy. They're kind of they're making money, and so if you have an underlying weakness in the economy, which we have today, they kind of bypass it, and then Wall Street gives them credit and says everything is fine. And that's not where you want to focus. You want to focus holistically, and you want to look at the whole picture. For instance, the housing market. If the economy was strong, the housing market wouldn't be a total mess right now where nobody can afford them. You wouldn't have an affordability problem, an historic affordability problem, where never before in American history has it been this expensive to buy a house. That's a big red flag. There's like, if you're 20 to 30, the chances of you affording a house is very low, right? It's like maybe 10% of 20 to 34. And the only ones that can afford a house is because their baby boomer parents have the money to help them. But if you don't have any help, this is just one example. I mean, I can go on and on and on about this underlying weakness in the economy. If you're a car salesman right now, in an economy that's strong, you're giddy. When an economy is strong and you go to work, you're going to sell 3 or 4 cars. Today, you're lucky if you sell 1 car a day. You're lucky. We got high interest rates. We got tariffs. The auto industry is, if you're a car salesman, it's a mess. Your real estate agent's a mess. There's 2 examples for you. If you're a small business owner, let's say you have a restaurant, you're just hoping and praying that you get through this weakness in the economy and that you don't go out of business. This is not a strong economic situation here, but yet stock market's an all-time high. But gold is the canary. Gold's up here at $4,000 going, problem here, problem here, problem here. And the issue here, what people don't realize is that the U.S. has been living on debt. And you can't do that. At a certain point, it all breaks. And so the key to it all is the bond market. The only reason why I own gold and silver mining stocks, the only reason is the bond market. So the bond market is the heart and soul of the U.S. economy. It's not earnings, it's not corporations, it's the bond market. Because the bond market is what creates liquidity throughout the whole system. The U.S. government basically borrows a boatload of money and they flood that money into the system, and it basically props everything up. It's a Potemkin economy. It's a fake economy. $2 trillion. We'll just print $2 trillion, just keep liquefying it, and everything's going to be fine. But it's a fake economy. And so eventually what happens is things slowly degrade, which we've seen over years. We talked about this concept of kicking the can. They keep kicking the can. We've heard that for decades, right? Well, Guess what? We're there. Now we see the wall. And what the wall is that the U.S. has been exporting their debt. And basically that's our export. Our main export has been debt. But guess what? Now foreigners are going, we don't want your debt anymore. Because the reason why is because we're exporting inflation. And we're exporting bonds that are going down in value. And they're like, hey, we don't want those stinking bonds. Okay, we'll take the 3 months. We'll take the 6 months. Maybe we'll take the 1 year. That's it. We don't want your 3-year, 5-year, 10 years. You can have those. In fact, we're gonna sell ours and we're gonna buy gold instead. That's what's starting to happen. And so we're up to $2 trillion deficit, and we've reached the breaking point. But Wall Street's in denial. Wall Street's, we can just keep kicking the can. Everything's fine. But if you look around, everything's on fire. And we're really, really, really close to when all that starts. And when it happens, the bond market is the key to it all. And everybody, the bond market will never break down. The bond market will never break down. Well, it already is breaking down. Foreigners are not showing up. The Treasury is borrowing money on the short end and rolling the debt over. So this year, they're going to borrow about $9 trillion. $2 trillion for debt, and $7 trillion for rolling over. And that $9 trillion is all going into short term. So next year, they got to do $9 trillion again. Where are they going to get $9 trillion if we're in a recession? Where's that money going to come from? Oh, the Fed's going to print it? Guess what? They can't. Because if they do, they burn the economy to the ground because they create too much inflation. Inflation is the killer of an economy. If inflation is a destroyer. It's the literal destroyer. It's the Achilles heel. It's the kryptonite of MMT. Once inflation shows up, the whole thing just burns to the ground. And they know it. And so at a certain point, they're like, well, we can't print that much. They're like, this is where it's going to all break, Darrell. This is where it's all going. The Congress is going to have their next beautiful bill next year. They're going to come around to the next year. We're going to have big, beautiful number two, right? And we're going to be in recession. And it's going to basically, we're going to be up to like 2.5 trillion. And Trump's going to throw this budget bill in there at 2.5 trillion. And the Treasury is going to go, Congress is going to go, okay, we want to borrow, we want to do a 2.5 trillion deficit. And Besant's going to go over to Capitol Hill and go, this might happen in 27. It might not happen in 26. He's going to go over to Capitol Hill and go, hey, guys, I can't borrow that much. I can't. There's not enough money. Now, I could ask the Fed to spend it all, but that's just going to, they don't want to. We don't want to do all this. So you're going to have to cut the budget. You're going to have to cut it. That's when it all unravels, because that is when the U.S., what we've been doing, the same old, that same game, that's when that game kind of ends. That strategy ends where you're living on debt. And suddenly, it's no different than in a family where a family has a budget. You know, they have a budget, say, of $5,000 a month, and then their bills start going up, and then they realize, well, we can no longer buy that. We can no longer buy that, right? We have to cut, right? It's no different. It's the same thing. The budget's going to have to be cut. And the reason it's going to have to be cut is because the bond market will not support it. It won't sustain it. And once the bond market won't sustain the needs of the U.S. economy, it's over. And so that's the end game. And that's what's coming soon. And there's nothing going to stop it. There's no way you can stop it because it's been in motion for 30 years. And so there's Trump didn't want a $2 trillion deficit, $2 trillion deficit. He didn't want $2 trillion. No way. He had no choice. That in a nutshell tells you how severe the problem is.
We've got three of the best porphyry copper targets that I've seen in the past 25 years of exploring for porphyries. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. We've put our foot on two outstanding projects in central British Columbia with copper and gold and some molybdenum in there. Our Poplar South project, we're drilling there at the moment, and I think we're on the verge of a major discovery. If you want to learn more, you can find us at vizslacopper.com.
Yeah, it reminds me of the movie the Titanic. You know, when they saw the iceberg, they could not steer out of the way in time, and everything just went down. And so, just thinking about the amount of force that this has been moving for decades, I'm curious about right now. The Fed is concerned about the job numbers. Obviously, the shutdown as well has been contributing to some of those decreases in jobs, as well as Amazon came out and said they're cutting 30,000 jobs as well. So the Fed's looking at rate cuts and such. And so how does that impact the interest that we're paying on the debt? Because the interest is over $1 trillion, and I'm kind of wondering, does that even make a difference? I imagine it doesn't put a dent in anything.
Well, they're going to have a hard time getting the long-term rates down. Last time they lowered rates, they came down, and then they just lowered them again, and the 10-year really didn't drop very much. It's still at 4%. It's come down tiny bit. I think it was like 4.1, 4.2, and then it came to 4. I mean, it didn't come down. And so it's still 4% is too high to borrow. They can't really borrow at 4. And so, but they're kind of stuck here at 4. But I don't think they'll borrow on the long term, the 10 years at 4. So it's going to be hard for them to get the 1 trillion down. Now, I do think they'll get the short-term rates down to 3% next year, maybe even lower than 3, maybe even 2.5. And that's what they'll borrow at. But then they have to keep rolling that over. But the problem is, can they get the 10-year down to 3.5? I think 3.5 is about as low as they can get it, and then it'll turn around and go back up because the Fed will start printing money to get the economy going again, and that'll push the rates back up. But I think 3.5 is about as low as they can get the 10-year, and I'm expecting it to go north of 4.5. once they start printing, it's just going to trend higher, and so it's going to be a big mess. And then again, the interest and the budget deficits, it's just a train wreck that you can't get away from. You mentioned the Titanic. I've said that we already hit the Titanic. We already hit the iceberg. Right now we're just playing it out. We're just waiting for the thing to sink.
Yeah, for sure. Yeah, so just thinking about gold and recent performance, and then obviously all of these factors that you laid out just really speaks to the conviction that you have, conviction that I have. And so for folks that are just getting into the metals, the recent performance could have easily scared them off. I remember looking at the data from the World Gold Council. They showed that we had record inflows in September into the ETFs, and then now, obviously a sell-off. And so I'm kind of wondering, with the targets that many of the big banks are putting on gold for next year, it really just supports your argument that, hey, this is really just getting started. And so just want to get any perspective you have there.
Gold and silver are really the only place to hide if I'm right. If I'm right that basically the U.S. bond market is heading to a point where first it becomes fragile and then it fails where they can't borrow what they need. If that unfolds, if you will, then foreigners will dump their treasuries and dump their dollars, which is already starting. You're already seeing the reserves where gold is passing up U.S. treasuries as reserves in governments. And so if this happens, that will speed up. And so if that speeds up, normally when you have a recession, normally people go to money market accounts and they go to treasuries. And so the dollar goes up normally, and rates go down, and you have more. That's been basically where people have hedged. They did not necessarily hedge in 2008 into gold. Gold didn't get a bid for a while. Gold crashed, silver crashed. So it took a while. I forget how many months it took, but there was not an initial surge back into gold and silver. The only reason why gold and silver rebounded is because they got sold off so hard. If you go back and you look at what gold and silver did, they got sold off really, really hard. So they bounced. They kind of rebounded, if you will. But it wasn't really, the demand wasn't really a hedge trade per se. It was more of a Momo. It was like, I'm gonna go buy that cheap gold, that cheap silver. Silver got down to $7. It was really, really cheap. It had to take off. And gold got really cheap too. So this is a completely different environment here. So now people have been buying gold. Central banks, they weren't buying gold in 2007-8. They were not. But now they are buying gold. And so everyone around the world is buying gold. Gold has demand. So gold is going to benefit from this uncertainty. So when this uncertainty happens, that's where if you're going to go hide, and it's going to happen the world over. So the world over is like, okay, where do I go hide? Do I go hide in my fiat currency? Do I go hide in U.S. treasuries? Do I go hide in my local bonds? Where do I go hide? Because I'm not going to go to my local stock market, because if the U.S. economy is burning down, probably the whole world is having trouble with their stock markets. So where do I go hide? And really, gold is going to be the number one place to hide. And so gold is going to bounce. So gold will go down initially. I was going to talk a little bit about my floors here for gold. Gold will go down initially when the stock market crashes, but it will bounce fairly quickly. I don't even think it'll take 4 to 8 weeks before gold, hits a new high. I'm thinking these corrections in bull markets, you're looking at like 4 to 8 weeks, maybe 12 weeks at most, for these corrections. They don't last very long. You can go back and look from 2004 to 2010. There's a lot of corrections, but they don't last very long, and then it goes back up. And so gold will get a bid, basically. If I'm right in my thesis, what I've laid out here, gold will get a bid. It'll get a serious bid. I'm probably too conservative I've talked about my exit plan. I'm going to exit early. I'm probably going to exit way too early. If this thing, if this thing, it depends on how fast and gold goes up and how fast silver goes up. But I'll probably leave way too much on the table because I got in early. I already have exit points. I hit my exit points and I'm out. But those exit points could be really, really conservative numbers, depending on what gold does. If gold goes to $7,000 in the next 3 years, I'll be leaving a lot on the table. And so, but people are still early because even I think that $5,500, $6,000 gold, that range, 5,500 to 6,000 is a really, really strong target. And then for me, 125 to 150 on silver. I think those two targets are totally in play here. And if we hit those targets, those are kind of my exit points. We hit those areas, the miners are absolutely going to fly. The miners are actually really cheap right now. They're cheap because Wall Street isn't involved. The free cash flow multiples. So normally people look at PE. So we got a PE of about 22, 23 forward on the S&P. The miners are not even anywhere in that area. I like to use free cash flow multiples. Right now, we're looking around 8 or 9 is where we're at for free cash flow multiple. We have a whole bunch of companies that are 3, 4, and 5 that are strong companies. A lot of them. We got Newmont under a 9 right now, which is crazy. It should be in the teens with these margins. The margins that Newmont has, it should be in the teens. So that's how you know you're early in a cycle. When they're cheap, when they have these really, really low multiples, because they have so much room to run. They're not going to get pricey. Newmont is not going to get pricey until it gets to 20. And you can buy it all the way up to, depending on if you're an investor, what kind of returns you want. But it's not going to get pricey for a while. These stocks are unbelievable cheap. I mean, people are very happy with 50% returns. I mean, if you can get a 50% return normally, that's fabulous, right? You'll be able to get a 50% return if you don't buy Newmont until you get like a 20 multiple. You'll still get a 50% return. So we got a long way to go here. Well, I say wait 2 to 3 years, but until it gets pricey, I don't think these miners will get pricey until maybe mid next year. I think we got until like maybe June. It's hard to predict how fast these miners will come up when they'll start to get pricey, but it's going to be a while before we start to see them. Like, there's not a single silver miner out there right now that's pricey, not one. They're all cheap, and silver's at $50, and nobody cares. Nobody's buying them. They're all 5+ baggers. It's pretty insane. I think Fresnillo is like a 4 bagger. It's like the only one that's somewhat pricey, but if the multiples blow out, we don't know how high the multiples will go, right? If the multiples blow out, I mean, Fresnillo is going to do a lot better than a 4 bagger. And that's at $100 silver. But I think we're going to 125 to 150. So if we go to 125, even Fresnillo is a 5+ bagger. So all the silver producers are cheap right now. And we're still early innings.
Yeah, for sure. So you mentioned earlier that you have a floor for the metal, so I wanted to touch on that. I also wanted to touch on, I was watching some recent content, and I think it's from Bald Guy Money, and he mentioned that the last year the central banks accumulated when the metals prices were coming under some pressure. And so I'm kind of wondering, if that's in the cards too, where, because you do have like a lot of institutions. What I've noticed and what I've seen is they've come and I've seen this even with Bitcoin. Like, there was a lot of hype around the ETFs. ETFs sold off significantly, and then before you know it, you see them bounce back significantly. So like, institutions were accumulating during that time, and so I'm kind of wondering if that's the case now. So what's your floor, and do you think like these huge institutions that have these price targets on gold are probably accumulating right now?
Yeah. Okay. So we'll start with the target, and I'm gonna do the accumulation. I'll do the accumulation first. I do not think that the institutions are accumulating miners because the valuations are too cheap. I mean, we have B2 Gold with a multiple of 3. It's like, it's like the risk reward is just absolutely ridiculous. I mean, it's a 1 million ounce producer with huge free cash flow, and it's trading at a 3 multiple. They're not accumulators. Newmont, again, under a 9. No, I mean, if anybody's buying stocks, there's a few companies out there, but they're the early birds. The only people who are accumulating is the early birds, but nobody's moving these prices now. Newmont went from 30 to 90, and now it's backed off a little bit. I haven't checked it today. It's probably around 80, maybe 10% back. I don't think it's gotten to 70s. I'm gonna check it. It'll only take me a second.
Yeah. And so you're looking at the volume.
79. Yeah. So it's at 79. It was at 90. So 10%. You know, it's about. It didn't do a 15% correction. So the HUI did about 15. So, but it's doing a little stronger. But so some people did buy it. You know, I said when it got to 30 that it was a total buy and you should buy it to the bottom, but it never got a 28 handle. It got a 29 handle, but it never got a 28. That was pretty much the very bottom. Some of these stocks for me, they become very obvious. They're bouncing on the bottom. When Newmont got to 30, I was screaming on Twitter that this is the bottom for Newmont. Can't go much lower than this. And now it ran from 30 to 90, which was 200% move. Very impressive. But I still think that it was the early birds. It wasn't really institutional accumulation. Not a lot of money flowing into these things because they would be higher. They'd be valued higher if we had, any interest in these miners. In my opinion, I mean, I've been following this for a long time, and right now I just see these stocks. I see 5 and 10 baggers just all over the place, and that doesn't happen. Perfect example is the Aussie stocks. For me, it's always been difficult to find Aussie stocks on sale. Like when I first started doing this, because they were always kind of pricey, because you always had to pay for that location premium, and then 2013 to 2020, we had this massive bear market, and everybody just got out, and the Aussies got cheap. And they haven't gotten pricey yet. And so for me, I mean, I look at like Vault Minerals, West Gold, Greatland Resources. Those 3 stocks are all trading at 5 and 6 multiples, and they're Aussies. And I'm like, what? Those stocks should be always trade double digits, especially with these margins that they have. These are companies that have really good balance sheets. $400 million in cash plus, all 3 of these companies, no debt, with good margins, generating a lot of cash, and they're trading at 5 and 6 multiple. It just shows you that nobody's paying attention here. These stocks should all be trading double digits right now, and these Aussies, I've seen it over and over again. They get pricey really fast, and you're like, I want that stock, and I won't buy it because once the stock gets, you make your money when you buy. And so, I mean, there was a lot of these stocks that I just waited, and then they got really cheap. And I have these stocks on my buy the dip list right now because they're so cheap. It's like, this is insane. And so I plan to add more on these Aussie mid-tiers when the crash does come. Now, Talking about when the crash does come, my floors, they keep going good. They keep going higher and higher and higher. So in silver, I had a floor of 34, say in August, July, August. I had my floor was about 34 for silver. Now I have it up to 37, and I think I have a range of 37 to 42. I think 42 has a good chance of holding. So we're at 47 right now. But when the stock market does crash, I think we'll go down to 42. And if 42 doesn't hold and then 40 doesn't hold, 37 is like worst case scenario. But if you think it in terms of a sigma, you got to go 5 sigma to get to 37. You're probably not going there, but maybe 1 sigma to get to 42. So the chances are 42 will hold if we go down there. That's kind of where I'm looking at. But 42 to 40, I think 42 is a good target area. If you're thinking about, if you're going to buy the dip thing, if you're going to wait to buy the dip, 42 is kind of a good place to be buying the dip. And then for gold, my target area is 3,500 to 3,700. And so we're at 4,000 now. So I'm hoping, I think 3,700 has a really good chance of holding. And we might not retest these levels, 3,700 or 42 silver. The key is gold. Gold is, silver went down 14%. On this correction from 54.46 to 46.77. But guess what? The only reason it went down is because gold went down. It wasn't the other way around. Gold is the leader. So gold went down 9.6% from 43.79 to 39.58. That's the big dog. When gold went down 9.6%, silver is always with an A, going to go down more. So when we get a correction, silver will go down more. That's how it works. Gold. See, all you do is pay attention to gold. You pay attention to what drives gold. Silver just comes along for the ride. It just comes along for the ride. But at a certain point, it becomes a monetary metal, and when it becomes a monetary metal, it outperforms gold because it wasn't a monetary metal. Suddenly, it is one, and once it becomes one, that's when silver rips. And so we can expect the GSR to go down significantly. Michael Oliver, I really respect that guy. And he's been saying that right now the GSR is 1.2%. He doesn't use a GSR of 80. He likes to use percentages. And I kind of like that. So if you divide 46.77 into 39.88, it was 1.2%. Maybe it got lower than that. I don't think it didn't get stronger because silver went down more than gold. Gold went down 10, silver went down 14. So it's below 1.2%, right? And he says that the norm is about 3%. And so he's expecting it to go anywhere from 3 to 6% on this bull market. But if we just go from 1% to 2%, you're looking at over $80 silver. You're looking now, gold doesn't have to move. If gold just stayed at 4,000 and we went to a 2%, you would be looking at, over $80, $85, 4,000, $80 silver. You'd be at $80 silver at 2%.
Wow.
So we're going to 2%, and we're probably going to 3%. And so as gold prices go up, so if you take, $6,000 gold and 2% is $120 silver. And I think we're going higher than 2%. So, and we're probably going to go to 3%. And so I think that's a good way to look at it, is that, 1, 2, 2.5, 3, 3.5. Use those percentages because there's a good chance that we're going to go to 3.5. Really good chance. And 2 is like easy peasy. But we're going to go somewhere between 2 and 4. And 4 is not crazy talk. 4 can happen. And so these percentages, when you use these percentages on gold and gold goes higher, it's pretty amazing. The upside.
Yeah, for sure. Yeah, definitely. Yeah, that sounds like music to my ears. However, I was kind of wondering about so we have the spot price of silver, which is ahead of the futures, and we have this kind of industrial demand competing with retail demand and such. And so like the stockpiles have been the supply has been tight, and then we've been in a deficit for the last however many years as far as the output for silver mines and such, and recycling and all of that. Do you think that does that compound on the issue, or do you think that's like part of the reason why silver will move like this?
Yeah, so this is a good topic. This is kind of a can of worms. is there enough silver? Period. I don't think there is. I wrote about this in my book when I first wrote my book, How to Invest in Gold and Silver. I'll give a little plug here. It's the only book that explains how to understand the gold and silver mining stocks, the juniors, the mid-tiers, and the majors. So check that one out on Amazon. So when I wrote that book, I talked about a shortage in silver is inevitable. And the reason why it's inevitable is because my thesis that the bond market is going to become fragile and people are going to run to gold, at a certain point, people will also run to silver. And there's not enough. Investors are going to overwhelm the fabricators. So right now, the fabricators need about 70% of the silver. And the reason why we've had deficits for the last 4 years of over 100 million ounces is investors have been overrunning the fabricators, exactly what I said was going to happen. And so the above ground silver is slowly been disappearing. Now, most of the above ground silver right now is sitting in the ETFs, about 1 billion ounces. There's not, in 1,000 ounce bar form, you got 1 billion ounces in the ETFs, and there's no way in hell there's another 1 billion ounces out there. No way. There's probably 100 to 200 million ounces. That's about, I think, all you have left in the 1,000 ounce bars. And the only way you get more is you either recycle, go to the refinery, recycle, 90% into the 1,000 bars, recycle, some of the jewelry, or you get more mining. But bottom line is, it's really difficult to increase the inventory. When you have deficits, to increase the inventory of 1,000 ounce bars is really, really hard. It's almost impossible. And so I think, and I always said this, that the investors are going to overwhelm the fabricators and you're going to run out of silver. And the only place there's going to be silver is in those ETFs. Now, the ETFs, the big guys can take delivery. You have to take delivery of 1 ton. But the big guys, the big institutional guys can do that. And so they'll start draining the ETFs, I think, is what's going to happen. But at a certain point, I'm expecting shortages. And once you get shortages, it's going to be really, really hard to find silver, and it's going to be really, really hard to restock the inventory levels. I think it's going to take at least 6 months. Once you can't find a kilo silver bar, a 10 ounce bar, when you can't find either of those on 100 ounce bars. So 100 ounce bars, 10 ounce bars, and kilos bars. Once those three are gone, you can't find them anywhere. You're going to $100 silver really quick. And I think it's going to happen where you basically can't find those. And those are made with 1,000 ounce bars. That's how it works. Mm-hmm. The fabricators or the refiners buy the 1,000 ounce bars, and then they convert them into kilo bars, 10 ounce bars, 100 ounce bars. And so if you don't have any 1,000 ounce inventory, the smaller bars will disappear first because they're not creating new ones because they can't find any. And so it's all about the inventory of the 1,000 ounce bars. And I'm expecting shortages. And I said it wouldn't happen until we got to $45 silver. And wasn't it interesting? As soon as we got to $45 silver, the LBMA started having problems with inventory in their silver. Didn't take long. It didn't even take a month. And so, yeah, it's coming. I believe shortages in silver are coming. And so, silver might be the new gold. It could be. It's hard to predict, but it's possible that silver could be the new gold, meaning that people would rather own silver than gold because it becomes so rare. It's like, I got mine, you got yours? I want some, I can't find any. So we don't know what's going to happen with silver, but it's a really fascinating metal. And right now it has some massive leverage. My target, like I said, my target is 125 to 150. I think it's too low. I think I'm being too conservative here. And so I'm probably I'll be exiting like right there, 125 to 150. And then if silver goes to 200, 250, I'll be missing out on all those returns. But
Yeah.
it's life.
Yeah, definitely. Yeah, it's hard. It's hard to call the tops. So just thinking about this deficit. So obviously, there's the industrial demand that's increasing, while this the outputs are not very lucrative, and silver being that byproduct of mining many of the other metals, gold, zinc, copper, and such, and it's not being a lot of the primary metal that's being mined. And so it seems like, I could see silver, becoming the new gold because of that nature alone, like the increased industrial demand that is just picking up, and there's just not enough to go around.
Right. China alone, if you look at what they plan to do in solar from now until 2030, they want 200 million ounces just for solar. Every year. That's 20% of supply just for solar, just for one country. So now the rest. I expect China's economy to slow a little bit, but I don't think that it'll slow enough for them to cut back on their plans for solar, because I think solar is a priority for them. So I think they will keep this plan, the solar build out, and then their electric cars. So their electric cars are going to use a lot of solar as well. So China and India alone, even if the U.S. has a severe recession and Europe has a severe recession, I think China and India alone will probably soak up enough silver. Now, China will soak up the silver from industrial use, cars and solar. India will soak up the silver because that's what their culture does. They hoard silver. That's their savings. That's their investment. They don't buy stocks. They buy silver and gold. So India will be soaking up silver, and China will be soaking up silver. So those two countries alone, as far as I'm concerned, is going to use up 40%, maybe more, 40% or more of the global silver supply. Just those two countries alone. And then I think the rest of the world is going to start wanting silver as an investment. So I think we're going to run out.
Yeah, for sure. So just thinking about, I was reading one of your recent articles, and you were just covering some of the stocks, the producers, explorers, and developers, and such. Obviously, the going perspective is that the explorers, more leverage to versus others, right? Like an explorer can give you a 10 bagger or whatever, right? And so, do you have you're in all of them, but if you had to pick one, which one would you be more interested in parking capital?
I'm glad you asked this question, because this is the first thing that I learned when I started out. So the explorers do not have a good risk reward. So I learned this very early. And so if you invest in an exploration stock, you're betting on one thing, that they find more gold or find more silver. So it's very important that you buy it at the right time, and it's also important where you sell it. And so exploration stocks, people, they generally don't buy them at the right time, and the only time you want to buy them is early in the Lassonde curve, and the Lassonde curve is the share price. So you want to buy them when the share price is very low. Basically, if they just made a discovery. And if you find the stock and it's not, the stock's not cheap, and and you look at the chart and it's not really early in the cycle, you're too late. So what if they have a good drill hole? You're too late. You don't want to buy it. You just pass. But if they made and the discovery has to be significant. I have a chart that shows you what is a significant discovery hole. So if it's a significant discovery hole and it's early in the Lassonde curve, that's not a bad play, because all they need is a couple follow-up holes, and you're probably going to make some money. And then it's just a matter of how much money you make. And the thing that's beautiful about those plays is it's inelastic. In other words, it doesn't matter what the gold price is or the silver price is. The only thing that matters is they keep hitting more good drill holes. And so they're inelastic, and that's one of the reasons why people love them. It's like, because you can find one early, it's like printing money. It's a beautiful thing. But guess what? They're rare as hell. You might only find one per year. One per year. I mean, I can go back, I can name 5 stocks in the last 5 years. That's about it. You know, you had Snowline about 5 years ago. You had Southern Cross about 3 years ago. You know, you had Goliath about 2 years. You had Collective about 5 years ago. Reunion had one a few years ago. But these stocks are very, very rare, where they're cheap and they make a beautiful discovery. They're rare as hell. One a year. And people are always chasing these stocks, but they're chasing them, and they're kind of, these are stocks that have made discoveries like 5 years ago, 10 years ago, and now they've ran a little bit, but they keep throwing out good drill holes, and they buy them, and they don't realize that the risk reward is not very good. So you have that. And then the only other time you want to buy an exploration stock is if you can buy gold in the ground really, really cheap. So if you can buy gold in the ground for $10 an ounce, and they have like 1.5, 3 million, 4 million ounces at $10, you just sit back and wait to get paid. Same with silver. You can buy silver in the ground for 25 cents, 30 cents, 40 cents, and then you just sit back and get paid. Those are optionality plays. But those are really the only two exploration stocks you want to buy. This is a lesson I learned. So the risk reward just doesn't work. So I have in my favorites list, I have a favorites list on my website, 82 stocks. There's only one exploration stock in there, only one. And the reason why is because in a bull market, you want elasticity. You want a stock that when the gold price goes up $100, $500, your stock participates. You want that strong elasticity because bull markets are rare. And when they come, you want that elasticity. Guess what? Exploration stocks don't have elasticity unless they're optionality. But early drill holes, no, they're all based on new drill holes, no elasticity. But producers, so you want to focus on producers first, cheap ones. You want to get good entry price. Then you just sit back and use that elasticity. And I'll finish there. I'll shorten my answer up. Producers benefit 3 ways, whereas exploration stocks and developers only benefit 1 way. 3 ways. First way is the price of gold goes up. So the price of gold goes up, their balance sheet improves. Well, that's a different way. The price of gold goes up, their revenue goes up, and the value of their company goes up. Second way they go up is their balance sheet improves, and they de-risk the company, and they get much more valuable because they have a strong balance sheet. So they get multiple expansion. Third way that they increase is they increase production, and they can increase production in a variety of ways. They can basically expand the current mine. They can build a new mine. They can buy a new mine. So we got 3 ways to grow through producers. The other 2, you got 1. Do the math.
Mm-hmm. Yeah, for sure. So what's your perspective on the royalty and streaming companies? I mean, obviously they trade at a premium, but they have a lot less risk compared to some of the other.
Yeah.
Yep, go ahead.
So my feeling on royalty plays is that they don't provide enough alpha. And so I consider them kind of good for diversification, but I prefer to diversify using ETFs and mutual funds. But you need to diversify your portfolio into lower risk stocks, and royalty plays are a really good way to do that. And so you can decide, how do you want to diversify? You can diversify physical, one way, majors another way, ETFs another way, mutual funds another way, and royalty plays. Those are your ways to diversify. So I don't have a problem with it, but I prefer ETFs and mutual funds, so I don't own any royalty plays. But I see them as a conservative way it's a conservative investment, kind of like ETF. And I like the bigger ones better. But the one thing I worry about on the royalty plays is they're currently valued about free cash flow about 30, 35, depending on the company, 25 to 35. So they have these really high valuations. And I don't know if those companies will be able to maintain those levels or increase them. So we're going to have multiple expansion in the producers. The producers are going to have uber multiple expansion. I say uber, I mean 1x, 2x, 3x, 4x. Whereas I don't think the royalty plays are going to have much expansion because they're already very valuable. And then in tandem with that, I worry about the model. So the way the model works is a lot of these deals are done on fixed. They're fixed. So let's say Wheaton has a contract where they pay $4 an ounce of silver in the ground for the life of the mine. Now that works fine up until a certain point. Because let's say that you're a producer and it's costing you $10 an ounce to produce that silver. So you're losing $6 an ounce, and they're paying $4 and they're getting $46 in profit. So you're losing $6, they're getting $46. So the model's already a little bit shaky, right? Now let's say silver doubles, right? Silver doubles, so let's say $80 or $90. Let's say 90, right? $8 and 90. Now they're getting $86 in profit per ounce. 86, right? And you're losing. Let's say that the costs go to 15. Now you're losing 11. You're losing 11 and they're getting 86. What are you going to do if you're on the board? I know what I'm doing. I'm calling them on the phone. I'm saying, this is messed up. We need to renegotiate this contract because this isn't working. And if the other side says, no, we got a deal, we got a contract, we're fine. If they say that, or like, well, we're not sending you any more silver until basically we're not tell your shareholders that you're not getting any revenue from us. That $86 an ounce, you're not getting that $86 an ounce. I think that the model, at a certain point the model breaks. That's my point, and we don't know when. We don't know when, mm-hmm. But you can't tell me that if that happens, if silver goes to $100, that everything's going to be kosher. What do you think, Darrell? You think everybody's going to be kumbaya? We'll just send you a check. We'll sell our silver to you for $4 and silver's at $100. What do you think is going to happen?
Yeah, there's definitely going to be some deals being made and some negotiations that are going to have to take place for sure.
There's going to be some changes, no doubt about it.
Okay, well, you got a few books out. Plug the audience with where they can connect with you. Obviously, they can go to goldstockdata.com, but you also have a couple of books out, and so I want to give you an opportunity to plug those.
Well, the only book I really plug is my gold book. It's How to Invest in Gold and Silver on Amazon. And if you own any gold and silver mining stocks, you need to read it. You're going to learn something. Oh, here it comes. There's my book. Beautiful, Darrell. Beautiful. You're going to learn something. Show them how thick it is. Show them how thick it is. It's a textbook. It's got some detail in there. You're going to learn. You're going to learn something. So, and if you want to get involved, you say, I want to buy some mining stocks. Read the book first, then buy the mining stocks. But I wrote it because it didn't exist when I started out. There was literally nothing on the market. So I'm like, okay. And I'm a writer. He said books. I do have multiple books. I'm a writer, so I'm like, okay, I'll write this book for you guys, so you guys can understand how to analyze these stocks. Oh, yeah. One last plug about the book. Chapter 10 of my book shows you how to value these mining stocks, how to analyze them. A guy took my chapter 10 and he programmed it into AI. And it's a beautiful thing. And you can just take that code and drop it into any of your AI things and say, and put a symbol in there like Newmont, and it'll spit it out and analyze it for you using my system. It's really cool.
Wow. Yeah, that's fascinating right there. I'm going to have to check that out.
Yeah.
Well, Don, appreciate you for coming on the show and everything. You all be sure to go check out goldstockdata.com, as well as check out the books that Don just plugged, and hit the subscribe button. Love to have your support for the channel as we continue to pump out content. And so thank you, Don, for coming on the show.